So what is the setup here for small caps and mid caps, and why do we think it's actually quite attractive at the moment? Well, you look at small caps historically over the last 20, 25 years, and they do tend to have a long-term history of outperformance versus the broader market. That's the bottom left chart there, both the Russell and the S&P small cap index significantly outperforming the larger S&P constituents. Obviously, during downturns, GFC and in 2020, they do get hit harder as well. But they also tend to do well from early in the recession. So on the right-hand side, you can actually see the relative performance of the Russell versus the S&P. They get hit harder into a recession, and they start to recover generally faster as you actually enter the recession as opposed to exit it. That's not to say this is going to happen exactly this time around, or even if we're going to get a hard recession, but the point is that the setup here is starting to look quite attractive. You look at the overall market exposure of small caps in the US, and it's sitting at around 5% of the total market. That number is actually near the COVID lows that we saw in 2000. It's usually higher. Important to mention, obviously, M&A as a potential tailwind. Smaller companies much more likely to get acquired than larger ones. And here's one of our favorite ones, and why we like kind of trying to dig up ideas in this space. There's hardly any brokers that cover some of these names. On average, these companies tend to be covered by 3, as opposed to large caps that are covered by 15 plus. That means that there's still a discovery process to be had. If they deliver, if they perform, if they continue to grow, it becomes a virtuous circle. Next slide, please. What's the actual valuation discount that we're sitting on at the moment? It's pretty significant. On the left-hand chart, you can see the price to earnings ratio of the S&P, which is the dark line, and the small cap index, which is the golden line. Obviously, since 21, you've had a massive pullback in that one. When you look at it on a relative basis, which is the right-hand chart, this is the relative premium or discount of the small caps versus the S&P. You've actually never been here. If I stretch this all the way back out, even past the GFC, back to pre-2000 levels, you've broadly traded in line to a small premium. You're at the moment sitting at a multi-decade relative valuation low for small caps. And as we've mentioned just now, 2/3 of our international portfolio is actually skewed towards small and middle caps. That has hurt us over the last 18 months, but I think puts us in a very strong position to outperform as this normalizes and recovers on a relative basis. So this is a pretty exciting opportunity from that perspective, and this isn't just a 5-10 year snapshot. This is a very significant low over many years. So what has the fund done in the past when we've had similar type drawdowns? You can see in 2016, 2020, and then now September 22, post these periods actually are 1 to 3 year performance tends to be really good, and that is due to the fact that we are exposed to sectors that do kind of get hit a bit harder, when things pull back. We understand that, but the other end of that is that they recover much faster and much more strongly, and you get rewarded on the other end. So you can see the 1 and 3 year performance during 2016 and 2020. Currently, we're starting to recover already at the moment. You can see that on the right-hand side. So it remains to be seen how deep the recession, if there is going to be a recession in the US, and how deep it cuts and globally. But there are a number of things that we're sitting on that we're very excited about that we think should do well, regardless, that are trading at very attractive valuations at this point.